Welcome, fellow Camelot apartment home investors. My name is Adam Roberts. I'm one of your partners in the Camelot deal, and this is our annual status update for the Camelot asset investment. Thank you for joining us and taking a few minutes out of your day to get a quick update on what's going on at the property, how the investment's looking, how it's performing, and some forecasts for the future. As we get started, I'm going to go ahead and share my screen and we'll get started with a quick disclaimer. Okay, as I said, this is our annual update, our review and strategic outlook for Camelot apartment homes. 117 units in Richardson, just outside of Dallas. We'll start by taking a quick look at our ownership period through the first 4 years. If you've been watching these updates the past couple of years, just like to highlight a few things that have gone on from a high level. Of course, the first couple of years were spent executing our business plan, installing several different capital projects around the property, doing remodels to the office and the pools, etc. We've been renovating units. We did an entire smart home campaign across the property. So all the units have smart technology for the residents, smart thermostats, keyless locks, video doorbells. The past couple years at Camelot, as is the case with most major markets, certainly Dallas Fort Worth across our portfolio, we've been playing offense on the sub-market fundamentals, occupancy, rent pricing. We've had to deal with a lot of new construction in and around not only just Richardson, but in Dallas, Fort Worth in general. That's been the case across many major Texas metros. And then entering 2026, we are all hands on deck. Still have a relatively challenging market. Transaction volumes are down, but we are firing on all cylinders, doing very well at the property in hand with our management company, Q10 Properties. Highlights and headwinds at Camelot. So today, as of this recording, we're 88% occupied, and we have or we finished May with almost $12,000 delinquency. That's just a highlight to the challenges we've been seeing in the marketplace. The occupancy at Camelot throughout the past 12 to 18 months has fluctuated between the mid 80s, the low 90s. We've had periods where we've done really well on occupancy, and we've had periods where we've struggled. We've had to be very nimble with rent pricing and stay on top of it as we go. Of course, we changed management companies across our portfolio February of 2025, so roughly a year and change ago. And very happy with our partnership, Q10 Properties, for which we worked with extensively in the Houston market. They now operate in the Dallas market, and we're very pleased with the partnership we have there with Q10. On the highlight side, I think you'll be pleased to know that we are exceeding our income projections nominally through the first 4 years of ownership. That's been a bit of good news. Even though we have had a challenged market, we underwrote relatively conservatively on our projections, and so we've done well from that standpoint on the income side. The expense side is kind of a different story. We'll talk through that in a second. But another major highlight that I think you will definitely notice upon visiting the asset is it's in really good shape. It shows really nicely. It amongst our peers in the submarket, our competitors, I think it looks the best. Certainly that helps immensely as we work through this challenged leasing environment. You know, having a place that people can call home, they feel safe, they know it looks good. We don't defer any maintenance. We take all that very seriously. So I think we're very proud of that. On the headwind side, income was great. Expenses were another story. Since the post-COVID timeframe, with a lot of monetary easing and different fiscal policy from the federal government, obviously we went through a significant inflation period. Expenses have stayed high now for a long time. We have just started to see an easing on things like property insurance, property taxes. That's been a bit of good news in the past 12 months or so. But overall, we are roughly 10 to 15% off the mark from our projections on expenses. Additionally, when it comes to marketing a property for sale in Dallas, Fort Worth, and metros across the Sun Belt, cap rates are not favorable today. So that's definitely a headwind as we look to the latter part of our ownership period here at Camelot. And then Class C apartments that are 1960s and 70s construction, Dallas, Fort Worth. We've just been challenged with rent growth and other submarket fundamentals. Occupancies have been a challenge the past 12 to 18 months, and you'll see that on the financials. Overall, we while we have had significant headwinds on the submarket fundamentals, the property shows very well. It's performed great within its competitive peer group. I think we stay on top of our leasing and our management very well. It's definitely a great property. It's the best in the submarket, and I think we're very proud to have it in our portfolio. Once the market does take a shift in the positive direction, I think Camelot's in just a great position to take advantage of that. Let's take a moment to recognize our staff, the folks that work at the property, putting together a culture of family and community. It's one of the things, it's the main reason we're in the business. We take it very seriously. We employ a organization called Apartment Life to help us with our events, and our management company has their own events as well throughout the month. Major holidays, back to school, pool opening, pool parties, things of that nature. We're just so proud to have all these events at the property. Bring the community together. It's a huge win-win. We believe that if you build the right community with the right culture and the right attitude, starting on the ground there at Camelot, it's a win for the folks that live there. It's a win for the folks like us that own the property. People stay, right? People stick around when they know there's a great place to live. So very, very pleased, very, very pleased with this aspect of our ownership, as we are across our entire portfolio. And before I get into the numbers and talk a little bit about where the property's performed over the first 4 years and where we're going, we'll start at a 30,000-foot view and just discuss some of the market fundamentals. I discussed a little bit about cap rates earlier, but there's also some other metrics worth discussion point. I've got three charts here, one discussing concessions, one showing cap rates, and one showing rent growth. And as you can see, we'll kind of move left to right. The leasing environment, the macro fundamentals for the market itself have really moved in new directions starting right around 2023. The green dotted line on these charts is where we acquired Camelot, right there in the summer of 2021. And concessions, you can see, were flat, moving sideways for a 2 to 3 year time period. And then as the market shifted, it really shot up. And we're now operating today at concession levels that we haven't seen since the early 2010s. So, of course, concessions are the discounts that we give to a prospective resident to get them to sign a 12-month lease. So maybe it's a free month of rent or $500 off their first month, or things of that nature. So that's really been a major headwind for the market in general. Cap rates moving in sync more or less with interest rates, you can see really shot up in the 2023 to 2024 timeframe. So when we purchased Camelot, right in and around the 5.75% to 6% cap rate, and those cap rates, which more or less move in unison loosely across different asset classes, whether it's Class A, B, or C. Cap rates have really expanded upwards of 150 basis points since when we were purchasing assets in 2022. And this isn't really news per se, but it is something that has happened the past couple of years, which it's good for all of us to be aware of. It's one of the reasons why it's not so easy to market an asset for sale these days. Cap rates have caused transaction volumes to really plummet. The root cause being, buyers and sellers are not on the same page as far as what they want to transact at, what price they want to pay for properties. So that has been a major headwind. And then finally, rent growth, year over year rent growth. And you can see this chart in particular is by asset class across Dallas. And you can see from the data set, Class C, which is where Camelot sits, has been hit the hardest, -6 to 8% rent growth in and around the 2024 and 2025 time frame. So, what does this mean for Camelot? A unit that we were able to charge, say, $1,500 a month, say a two-bedroom unit, $1,500 a month in rent back in 2022, 2023, we're now only getting, maybe $1,300 or $1,400 a month today. And you multiply that across 117 units, and it takes quite a significant hit on the financials down to the bottom line, net operating income. So here is really the macro look at what we've been dealing with, and now we can kind of dive in and look at the numbers. So give everybody a feel for the type of value we've added at the property, how we've handled the headwinds, right? How we've actually been able to succeed amongst the significant, market fundamentals that I just discussed. Seller T3 is listed there on the left-hand side in the left pane, just to kind of baseline us where the property was operating before we bought it. You can see in the first couple years of ownership, we really implemented our business plan well from an income perspective. Just right out of the gate, significant progress, and today operating right in and around the $2 million annualized income mark, up from the 1.58 million that the seller was operating. Just really, really incredible in this market. Just really, really good. Very happy with our on-site teams establishing that. On the flip side, you can see we have been burdened with major expense increases as well. Whereas we were operating in and around the $600,000 to $700,000 a year realm, that has increased to over $1 million in 2024. And then in 2025, like I said, with our management company change, a little bit better expense management came our way. We're starting to see good savings on insurance and taxes. So that's been a major positive. I do believe 2026 will probably come in right in and where 2025 came in at. So very happy that we've started to see some downward pressure there, but it's taken its toll, right? NOI growth has been positive overall. So we've been on an upward trajectory there. Very happy with that. Because that's what we can control, right? We can't control cap rates. We cannot control the velocity of transactions in the market, but we can control the operations at the property. So we feel like we've stayed very, very on top of that. I put a property value line there, and that's subjective, right? That's just based on the cap rates at the time during the year. Cap rates have expanded, right? So like I said, we acquired in and around the high fives cap rates, and we're in a market environment today where we are somewhere around 6.5 maybe. Some of these assets are distressed and maybe trading a little bit less favorable on price, but again, we've been able to, at least in this market environment, keep a positive trajectory on property value. So that is definitely significant. So very, very happy with that. And I show the same chart here on the right-hand pane, except it's a cumulative chart. All the actual year-over-year income, expenses, NOI, P&L versus the projection. And we're definitely down versus the projections on NOI. But like I said, I think when I look at this, knowing what we are dealing with the past couple of years with where the market's at, I couldn't be happier. I think it's just really in a great spot. And it has allowed us to preserve investor capital and also potentially return a profit here when we can exit. 2026. So how are we kind of lining up this year now that we're 5 to 6 months through the year? Have a really good handle on where the property is performing, where I think it's going to go. And like I said, I think expenses are going to be relatively flat, maybe just a small tick up. It's definitely higher than what we thought we would be at when we underwrote the deal 4 years ago. But overall, just a good story. I think that's just a way to summarize this chart. Good story. It's not where we project it to be, but with the market forces that have taken place, I'm happy with where we are. I think we've done a phenomenal job. I think we will continue to take advantage of what the market gives us, right? I think we're in a great position for that. So I think that's good. On the balance sheet side, healthy cash accounts. I think we're again in a good position from a cash perspective for 117 unit property to handle whatever comes our way. So all good there. As I do with all of our assets in these video updates, I put together a 3-year projection where I think we will be operating based on where I believe the market might be going. Also, trying to keep it relatively conservative. There's been a lot of speculation in the marketplace amongst those who track a lot of data. The Real Pages of the world, the Co-Stars, Yardi, people who are full-time job is to track this stuff. There's been a lot of speculation about improvements coming our way. Construction is pretty much non-existent to anymore, right? We're still going through some lease up activity in Dallas Fort Worth, but there has not been any substantial permitting or construction starts, which has really hampered the overall apartment market the past couple years. So they're anticipating some rent growth coming our way this year, next year, into the future. I've underwritten kind of a nominal rent growth into the next 12 to 18 months. Historical rent growth I don't really have on this screen, but we could return to historical 3 to 5% rent growth if we get a healthy market. But you can see overall, I would call this a conservative underwrite based on where I think the market could go. Economic vacancy burn down, things of that nature. The submarket still is operating with a good amount of economic vacancy, and what are the two primary things I'll say that go into that? It's really the concessions are impacting that significantly. Physical vacancy, you saw we're 88% today. So if 20% is today's number, 12% of that is physical, and then the remaining 8 is really losses on concessions. So I think as the market improves and we get a tighter supply network of apartments in the DFW area, that concession piece will start to go away, as will the physical piece. So healthier there. Again, the property value line at the bottom is purely speculative. I've held a 6.5% cap rate throughout the 3-year period, but you could apply maybe a small cap rate burn down. There's been some speculation about interest rate movement. So maybe cap rates get closer to 6%. That would be certainly very favorable for us. But if we assume that it's just a flat cap rate environment, $18 million out in 2028, we would just have to see what the market gives us. I put a little bit of a snippet down there. An $18 million sales price provides a approximately 30% return on investment, or a 1.3 times your investment. So in this environment where I know we have a lot of operators that are struggling and there's a lot of equity loss, this certainly would be a very good story. Good preservation of capital, a little bit of profit. We'll just have to see what the appetite is of the market, and if that's the appetite of our partnership group. If we want to pull the trigger at that point, maybe we do. We'll see. But just wanted to. This isn't necessarily a commitment of of selling the property at a certain point for a certain return. This is just trying to get everybody's frame of reference around what the numbers mean. So at the end of the day, our loan does mature in about 4 years. So we've got that to deal with. So what to kind of wrap things up here, what is your general partnership team doing on a day-to-day and week-to-week basis? Well, for a stabilized asset like Camelot, it requires us to continue to manage the property with a hands-on, perspective. We stay very close with our management company, Q10 Properties. They're a great partner in the deal, and it's been a great experience. I think I can speak for all my partners in saying that they have really elevated our portfolio. It's not an easy market out there. Okay, it's been very, very difficult, and it takes a collaborative effort between the ownership group and the management company. And so we're going to continue to do that, right? We have a great operating rhythm. We're going to continue to be hands-on. Secondly, we keep our ear to the ground quarterly. We get together, look at cap rates, understand what the market's doing. We've got other assets in our portfolio, some of which are going through refinances or some that are transacting. So we have a very firm understanding of the marketplace. We've got a deal right now on the market that offers just came in, and so we get a chance to look at cap rates and what people are wanting to transact at. And so feel like we're in a great position to kind of keep our ear to the ground and understand how Camelot can benefit from that as the months go by and we kind of see where the market sits. So, as I said on the prior slide, I don't want to make any commitments on behalf of our group as far as where we might transact. It may not happen for another 12, 18 plus months. I think right now it would behoove us to wait for a better marketplace. Today, the market is just not good. The transaction volumes are down double digits percentage wise. There's not a lot of, I would say, qualified buyers on the market, right? I mean, there's a few folks that are starting to become active, folks that can get financing and raise equity, but all those puzzle pieces really impact the health of the market, i.e. the cap rate, i.e. the price you can get for a beautifully performing, stabilized asset like Camelot. We want to take full advantage of the best market we can. So we still have time on our side to do that. Okay, well, that's a wrap. I hope you all have enjoyed a quick status update and review of the Camelot Apartments in Richardson. Really appreciate everybody's trust and loyalty, and appreciate everybody being with us in this journey. So far, it's been a good investment. So far, it has really stood the test of the market compared to where I do see a lot of other assets performing. So we're very happy with that. We are excited with where the future sits over the next 12 to 18 months, and we really appreciate everybody. So thank you so much.